Hi, everybody. Jen Berbas with the Berbas Group coming to you with a review of the October real estate numbers in Austin, Texas. I hope everybody's enjoying our first real cold front of the year that came in this morning. It's pretty great. Austin real estate market continues its pattern of adjustment to our new normal. I have the highest inventory that we've had in 14 years, but things are still getting sold. We have a 90% success rate with our listings, so we're pretty excited about that. It's a challenging market for sellers, but we're going to go over 5 key highlights from the data from last month. Total sales in October fell 5% from that month the previous year. Average sold price went up 6%. So total sales went down, average sold price went up. That indicates to me that it's just a little bit higher end of the market that's doing a little bit better, but we'll dive into that here in a little bit when we look at the numbers. New listings are up 10%. This is kind of huge, right? We know that we are in the highest inventory environment that we've had in 14 years, but since last year, inventory is up 10%, and we'll dive into that in a second here. Days on market is up to 89 from 80 last month. And then months of inventory has grown 10% up to 5.3 months of inventory. This is a metric that is very, very different in every submarket. Every time we meet with one of our sellers, we look at the inventory for their area so they can just understand what they're up against. So you'll notice this is what we were talking about a minute ago. Total sales are down 8%. But if you go down to average sold price, it's up 8%. You can accomplish this a couple different ways, right? For average price to be up, prices may truly be coming up. Or the part of the market that is at a higher price point is doing better because those participants in the lower price points of the market are struggling more, and there's not as many transactions happening, let's say under 500, under 400. There just may be more transactions happening in the higher part of the market. So you can accomplish this, increase in average sold price a handful of different ways. So I think it's really interesting to stop and pay attention to why is the average sold price going up when total number of sales is going down. I don't think that's necessarily an indication of broad strength across the market. Average sold price per square foot, you know how we feel about price per square foot. We don't love it as a metric because we think it ignores land value. And there's a lot of neighborhoods in Austin where houses are transacting and 90% of the transaction value is actually in the land. So that's an interesting one to kind of look at. Average days on market is up. It is harder for sellers to get their homes sold in this market than it's been in the last couple of years, but I think both the sellers and the realtors are getting better at explaining the data and understanding the data. So to us, it feels like the market has stopped being seized, if you will, the way it did a year or two ago. There are still transactions happening. You can still get a house sold. You just have to be presented really, really well and priced really competitively. Months of inventory is up 18% from this time last year. It's interesting. We saw in the data that we collect, which you'll see here in a second, that we collect on a weekly basis, you can see an uptick of inventory this last couple of weeks. I think that's the people that are trying to get their homes sold before we go into the fall season, before we go into the holidays. This is that chart I was talking about. You can see here we have this little blip of an increase in inventory and active inventory. The reason why we collect this data is when you wait for the Board of Realtors data to come out, which is what we're reviewing with you on a monthly basis. By definition, some of that data is 6 weeks old. So we want to make sure that we're looking on a weekly basis when we go to list our listings with our sellers and go through the data with our sellers. If you look right here, between here and here, there's this moment where the inventory increases 20% in a 4-week time span. And we want to make sure our sellers are seeing that on a week-by-week basis so they can price more competitively and just get better outcomes. 5-county metro average and median sold price. We're bouncing along the bottom here is what it feels like to us. It doesn't really feel like these are true price changes. Real estate is not like a stock. You can't market to market every month or every week. It's just not like that. It's interesting to watch this, but really it's better to step back a little bit from the pricing and look at it from a 10,000-foot view if you're looking for the broad Austin direction. And if you're looking for your neighborhood, it's far better to go down to the granular level of your neighborhood and look at that data specifically. Average median sold price is really swung around a lot in the last 24 months. It seems like it swung around more this year than it did last year even. But again, important to kind of take this with a grain of salt. Try to pull out from this and look at it from the 10,000 foot view. We don't try to time the market in real estate any more than we do with our stock portfolios. It's just not a fruitful exercise. So this is something that I think is really interesting. Total sales are down 8%, but the average sold price is up 8%. And this is what I was talking about earlier. How do you accomplish this? Fewer transactions, higher prices. Well, that means that the homes probably at the higher end of the price range in Austin are transacting more easily. That also probably to me means that there's a disparity of the ability to get mortgages and the willingness to transact based on the price point. I think that's interesting. I think that says something about where we're at from a reflection of our economy. Pending units by month, nothing too surprising here. Yes, we have more pending units slightly this month than we did in October of last year. And then new listings by month, this is what we were talking about. We're seeing this little uptick in inventory, available inventory. This is probably a couple people just trying to get their homes on the market and sold before the market goes to sleep for after Thanksgiving. We actually have a couple new listings hitting the market we're really excited about. But generally, this time of year, people aren't listing as much. And so that's what you're seeing here reflected in this data. Thanks, guys, for spending so much time with us and going through the numbers with us. A couple high-level economic things I want to make sure we talk about. So there's an interesting high-level global economic thing that came about this last week that I want to dig into more. Somebody sent me an article about Greek bonds trading at 3.3%, where the 10-year Treasury in the U.S., which, by the way, drives mortgage rates. We all know that. We've talked about that a lot here. Nobody that's connected to us thinks that the Fed controls mortgage rates directly. Everybody understands that's a derivative and that the mortgage rates are driven off the 10-year Treasury. 10-year Treasury has been trading in the mid-4s lately, and that's traded at the Chicago Mercantile Exchange. And Greek bonds, which are based in euro, obviously, are trading at 3.3. In the same way, a lender or a borrower that is getting a mortgage from a U.S. bank has to pay a higher interest rate if they have a worse credit score. Likewise, countries have to pay more to borrow money if they are deemed by the market in general to be a higher credit risk. There's a lot of things that go into the rates on the U.S. Treasuries. It could be a reflection of monetary policy. It could be a reflection of CPI numbers that indicate we're going to have inflation. And it could be creditworthiness. There's a lot of different things that go into that rate, but it's really interesting to see the U.S. bond rates at a higher interest rate than Greece. Greece has historically not been a great credit risk. If you guys know me, you know that I worked in credit default swaps after 2008, after the crash. And Greece surely was not paying less than the U.S. at that point to borrow money. Before our next visit, I'm going to go dive into the historical difference between U.S. bond rates and Greece, because to me, this just seems really unusual. And I'm curious to see if this has happened before with European bonds and U.S. bonds. With that, I hope you guys have a great November. We'll be seeing you guys for Pie Time with the Berbas Group, and see you next month with a review of the November data. Talk to you soon. Bye.